Hi everyone, it's Rich Warner from wealthmaxbuilder.com. This is video lesson 3.3. We're going to continue our discussion of dubious investment ideas you should avoid. This is part of the video series from Essentials of Investing, which is my ebook that's available on Amazon as well as on my website at wealthmaxbuilder.com. Again, please take a brief moment to review the copyright policy and the disclaimer statement. You can pause the video if you so choose. Thank you very much. So today's lesson is about convertible bonds, or converts as they're known for short. Now, a convertible bond is really a hybrid security. You can ask yourself, is it a bond or is it a stock? Well, converts are a combination of bond and options. A convertible bond is comprised of a subordinated bond which is issued at a lower yield, and in return for the lower yield of the typical corporate bond, you've got an options feature that is based on the underlying stock performance, giving you lower yield plus potential upside in the options on the underlying stock of the company. Now, this being a chapter on dubious investment strategies, you won't be surprised to see that there are quite a few disadvantages with converts. First of all, they're giving you lower yields at the outset because in return the company is giving you potential upside in an options contract. And because of that extra options or equity feature that's attached to the bond, converts exhibit 3 times as much volatility as the average investment grade bond. And they're 2 times as volatile as most high-yield bond funds. You assume more risk for the equity feature that is coupled onto this subordinated lower-yielding bond. The extra volatility of this equity component reduces the reward-to-risk ratio, meaning you're not getting as much reward for the amount of risk that you're assuming. These levels of reward-to-risk are so unfavorable when compared to other bond funds and optimized asset allocations. To show you this on a chart, I've pulled up a total return performance chart from Morningstar.com. And it shows you the Vanguard Convertible Bond Fund in blue, which is the blue line here. And it shows you the mid-cap stock index, which is purely mid-cap stocks. That's the orange line. And we also have the intermediate U.S. Treasury Bond Fund from Vanguard as well in green. Now, one of the things you notice here is that, over long periods of time, convertible bond funds should outperform the intermediate Treasury bond index because of the equity feature that is hooked up to the subordinated convertible bond. But as you notice that in the bear market periods, the drawdowns can be severe. You get incredible volatility during bear market periods, and along with the stock market, these convertible bonds perform quite well. So when you look at it over very long periods of time, the convertible bond fund is behaving more like a stock than it is a bond, which raises the question, why should you even bother being in convertible stocks? Why don't you just allocate a certain percentage to a mid-cap stock fund and have a certain allocation for the investment grade bonds or U.S. Treasuries? No need for converts, really. So in summary, you really don't need a convertible bond fund. You should be allocating to a broad diversified stock index like the mid-cap stock index in this case, a certain percentage, and the rest to an intermediate or investment grade Treasury bond fund. You really don't need to take this halfway position with a convertible bond. Just get the asset allocation right and you will be fine. Moving on to our next dubious investment strategy, let's talk about TIPS. What are TIPS? TIPS stands for Treasury Inflation Protected Securities. These are Treasury bonds issued by the United States Treasury with a coupon that is fixed over the life of the bond, but the principal of the bond, or the face value, is being adjusted according to changes in the CPI index. And the CPI index is really the consumer price index, which is a measure of inflation across the board in the U.S. economy. Now, this concept of a tip may sound appealing, especially in environments when interest rates are expected to move higher and Treasury bonds will take it on the nose, and Treasury bond funds as well, and bonds in general don't perform well in rising inflationary environments. The thing that I don't like about TIPS is that they also don't protect you in bear markets. Let's have a look at this graph, for example. In 2008, the S&P 500 was down about 35–36%, and you would expect the TIPS bond funds to have performed well in 2008, when in fact the Vanguard TIPS fund was down 2.85% in 2008. So TIPS offered very little, if any, protection on the way down in the bear market of 2008. Meanwhile, the intermediate U.S. Treasury ETF, ticker symbol IEF, was up by almost 18% in 2008. So the Treasury ETF protected you in the bear market of 2008, whereas the TIPS bond fund did not protect you at all. And that's a major problem that I have with TIPS. I'm not in disagreement that in an inflationary environment, TIPS will do fairly well. As inflation goes higher, CPI index goes higher, and your principal increases with a fixed coupon. However, in a bear market, which is why we look to bond funds actually to help stabilize your overall asset allocation, your overall investment portfolio, intermediate and long-term U.S. Treasury bond funds are going to protect you in bear markets, whereas TIPS do not. Now, FRNs are similar to TIPS in the sense that they're supposed to give you some sort of extra compensation in inflationary environments that bonds generally cannot provide. FRN stands for floating rate note, which means that the coupon is adjusted by some benchmark interest rate, like LIBOR. LIBOR stands for the London Interbank Offer Rate, which is a benchmark interest rate that is used for dollar-denominated euro bonds. In an inflationary environment, an FRN will adjust its coupon higher, and you get higher payments for that, and that's a nice thing. The only problem is that most floating rate note funds are highly leveraged. So here we have a chart from Morningstar again, showing the floating rate fund, ticker symbol FRA. As we notice in 2008 during the bear market, FRA was down 36.2%, which isn't much better than the S&P 500. Actually, it was very close to the S&P 500, which was also down by 36-point-something% that year. And as you can see from this chart, over a very long period of time, and not only did FRA not protect you at all in the bear market of 2008, but over the very long haul, it seems to have gone nowhere. If you compare it to the performance of the aggregate Barclays bond benchmark bond index in green, let alone the stock market itself, I mean, FRA is a terrible investment. Again, so who needs an investment that's going nowhere over long periods of time, that's highly leveraged, and is providing you no downside risk in bear markets? So avoid TIPS and avoid FRNs. Well, that's it for this lesson. I hope you enjoyed it. In the next lesson, we'll talk about leveraged securities, particularly futures, options, and ultra ETFs. Thank you for watching. I hope to see you in the next video.